Just on Amazon itself, what will the street be looking for in terms of, balancing worker protections with looking for better sales growth?
Right. So, good morning, Vonnie, and thanks for having me. So I think what we're expecting, obviously, I think this quarter, Amazon is very well positioned from its e-commerce business. You always hear a lot of noise about things like this, health issues and so on. Over the years, I think the company has done a pretty decent job in navigating those. So more or less, I would view those as headline risk as opposed to having any major impact in terms of what we expect for this quarter, which is that they're going to probably, beat expectations based on the guidance they provided last time pre-COVID. Now we know that there's a major spike in e-commerce volumes. Prime membership should benefit significantly from this in-home confinement and the video viewership as well. And also, don't forget the Amazon Web Services, which should be a major beneficiary of this transition to the remote workforce, as we saw from Microsoft Cloud business yesterday. So there's a lot of powerful headwinds, Vonnie, that should really bode well for the Q1 results for Amazon.
Right. Amazon seems to be sort of in the winning camp in many of these niches. Tuna, overall, we've seen several media stocks already report now. Who will be the winners and who will be the losers?
Right. So that's a great question as we just got off the Comcast earnings call. And, clearly, I think the broadband business, those companies that have, high-speed internet should benefit from this surge in traffic. We're seeing streaming platforms. We just talked about Amazon, like guys like Netflix and Comcast going ahead to launch their Peacock, even in this environment, really spoke to how, trends are benefiting from these tailwinds. And then we also see companies that have theme park exposures, live entertainment that are really being hit hard from exposure to the shutdown of the mass gatherings. And then the advertising business seems like it's pretty down dramatically. This should affect a lot of media companies. So I think it's really a mixed bag at this point, depending on each company's portfolio. The more longer-term revenue streams, multi-year affiliate deals, those seem to be relatively immune to this cyclicality. I think as we think about the rest of the year, this is going to continue, potentially accelerate in the second half, especially as we look forward. I think the question becomes how long the recovery takes. Right now, no one really knows. So I think for the most part, investors should be looking ahead to 2021 to see which of these companies are best positioned. And we think those that have stable businesses and streaming likely to benefit from extended in-home stays will really fare the best. Yep. And those that have exposure to mass gatherings will fare the least.
Tuna, can I just I want to put these two subjects together. I'm wondering, how do you value the Prime Video business that Amazon has? Competition is heating up. Clearly, it's a reasonably high cost part of the business. How do you value it? And do you think that ultimately could be a part of the business that could need to be valued differently, given the multiples that are being applied elsewhere?
Well, that's a question that we've kind of tried to, navigate. One thing that we know is that, the Prime Video business is actually a major catalyst for the Prime subscriber business, Prime subscriptions. As you know, the video business is a perk within its Prime membership base, which we expect would have accelerated in this environment. So you can't really value it at this point as an independent standalone business. There's not enough granularity to do that. That being said, there's a lot of intangibles that they're getting from the ability to provide that as a perk alongside so many others within the Prime subscription. And that's why they're spending heavily in content and whatnot. This year, we think that content spend could be north of $6 billion. So obviously, there's questions how to calculate the return on investment. I would argue that in these times that people are staying home, that argument for continuing to provide that will be even more compelling, as we see from others like Netflix and Disney+.
Tuna, can I ask you a kind of more broad question? The S&P is being driven by a handful of stocks, 4 or 5. And the concentration into those tech names seems to be getting greater and greater. As an analyst watching what is happening in this space, how are you factoring that concentration into your thinking about whether or not you want to own these stocks or not own these stocks?
I think that's a very good question as we think about the market leadership. The FANGs have really taken that lead, and I think some of that is actually, accidental because, these FANGs, for the most part, tend to, have a longer term, cycle, maybe to some respects less cyclicality, and then also the secular trends that we talk about in streaming. And tech spending and remote workforce, things of that nature. Now, that being said, when you look across the landscape, there's no question that there's sectors that are hit the hardest, whether it's the travel or casinos and all of those areas, retail. So the leadership at this point, investors are looking for quote unquote, safe havens. And I don't know that there's necessarily a perfect safe haven at this point. But as you look at the FANG stocks with all the reduced noise about the regulatory, no one is talking about that at this point. The focus now is on which companies have the strongest balance sheets to be able to navigate these uncertain times, ample liquidity. And I think these names that we talk about have a significant amount of dry powder that should enable them to come out of this, arguably in much stronger position. The question is how long that takes. So I think that's what investors should be focused now as they look for market leadership within a narrow concentration of names.
Tuna, you mentioned the gambling industry just then, and I know that you cover some of the casinos and cruise industry companies, and I'm wondering, when we see today personal spending down 7.5% in the United States, do those kinds of industries bounce back in 2020?
No, I don't think they're going to bounce back in 2020. There's a bifurcation here in the casino industry, as you know, in Macau, China, where, by far the largest, gambling market in the world. They just reopened not too long ago after this major shutdown. Now, we know that gross gaming revenues in Macau, China, we're still down, almost 90% in March. April numbers are still awaited. We don't know. We think it's going to be a very long and arduous recovery journey, and we don't see that happening this year, even as the casinos have really come back to limited, reopenings. Now, within the U.S., the recovery will likely, take much longer. We hear in the Wynn Resort CEO saying that they're going to reopen by Memorial Day, which we think is optimistic. But even if they do, there's going to be definitely a new normal in how these casinos operate. They're going to be significantly below capacity. A lot of these casinos have a fairly high daily expense burn rate that they continue to incur in the millions of dollars, even while these casinos are closed. So it's going to really be a tough, battle, really getting anywhere close to some semblance of normalcy, and we don't see that happening, frankly, this year.